Commercial airlines operate fleets of massive multi-million-dollar jets. Historically, however, these aircraft were rarely listed as assets on the airline's financial statements. Under the previous standard, MFRS 117, many of these agreements were classified as operating leases. This allowed companies to keep significant rental obligations off their balance sheets, reporting them only as annual expenses in the footnotes. MFRS 16 eliminates the distinction between operating and finance leases for lessees. For the company renting the asset, the accounting treatment is now unified. The core principle states that if a contract conveys the right to control an identified asset, the lessee must recognize a right-of-use asset, or ROU asset, and a corresponding lease liability. An ROU asset represents the lessee's right to use an underlying asset for the duration of the lease term. This standard closes the loophole of off-balance sheet financing. It ensures that heavy lessees can no longer present an illusion of low financial leverage while maintaining massive unrecorded rental debts. Determining if a contract falls under MFRS 16 requires a two-part assessment: identification and control. First, the contract must specify an identified asset, pointing to specific property, plant, or equipment. This identification is negated if the lessor retains substantive substitution rights. If the supplier can easily swap the asset and benefit financially, no identified asset exists. If the asset is identified, the second condition is control. The customer must hold the right to control the use of that asset throughout the period. Control requires that the lessee obtains substantially all of the economic benefits from using the asset, whether through its primary output or other commercial benefits. Finally, the lessee must have the right to direct how and for what purpose the asset is used. They must hold the decision-making power over the asset's operation. If a contract fails to meet every node in this matrix, it is accounted for as a service expense rather than a lease, meaning it does not appear on the statement of financial position. Many real-world contracts bundle the right to use an asset with additional services, such as maintenance, insurance, or cleaning. MFRS 16 requires allocating the total contract price to each component based on standalone prices. In this example, a 6 million ringgit rental splits into an aircraft lease, capitalized as an asset, and a 500,000 ringgit maintenance service, treated as a separate operating expense. Failure to separate these elements results in an inflated lease liability, overstating the company's recorded debt. Lease recognition begins on the commencement date, which is the moment the lessor makes the underlying asset available for use by the lessee. At this point, the lessee recognizes both the right-of-use asset and the lease liability on the balance sheet. To manage the administrative burden of tracking minor contracts, MFRS 16 provides two optional exemptions. The first exemption applies to short-term leases, defined strictly as contracts with a lease term of 12 months or less. The second exemption applies to low-value assets, such as personal computers. This is assessed on an absolute basis. When an exemption is used, the lessee bypasses the balance sheet and recognizes lease payments as a simple straight-line expense over the lease term. For all other leases, the first step is calculating the lease liability. The lease liability is the present value of all unpaid lease payments. These are discounted using the interest rate implicit in the lease, or if that cannot be determined, the lessee's incremental borrowing rate. The incremental borrowing rate is the interest rate a lessee would pay to borrow the funds necessary to obtain an asset of similar value over a similar term. This initial liability calculation then serves as the starting point for measuring the right-of-use asset. To find the total cost, you add any lease payments made before commencement and initial direct costs incurred. You also include estimates for dismantling and removing the asset, while subtracting any lease incentives received. Conceptually, the lease liability is the financial debt owed, while the ROU asset represents the total capitalized cost of controlling the asset's use. Once the lease is active, the asset and the liability follow different mathematical paths. The ROU asset is typically depreciated on a straight-line basis over the lease term, mirroring the depreciation of owned equipment. The lease liability is amortized using the effective interest method. This means interest is added to the balance over time, while cash payments reduce it. Consider a Mana BHD, which has an initial lease liability of 917,600 ringgit, an interest rate of 6%, and annual payments of 80,000 ringgit. In the first year, interest is 6% of the opening balance, totaling 55,056 ringgit. After accounting for the 80,000 ringgit payment, the principal is reduced by 24,944 ringgit. This leaves a closing liability of 892,656 ringgit. Since interest is always calculated on the remaining balance, the total lease expense, combining depreciation and interest, is higher in the early years of the contract. On the statement of financial position, ROU assets are non-current assets. The lease liability is split into current and non-current portions based on the repayment schedule. In the profit or loss statement, the single rental expense of the past is gone. It is replaced by depreciation, an operating expense, and interest, which is a finance cost. On the statement of cash flows, the principal portion of the lease payment appears under financing activities, while the interest is classified according to the entity's accounting policy. This shift impacts key metrics. Moving the lease payment from an operating expense to depreciation and interest increases a company's EBITDA. EBITDA is a performance measure representing earnings before interest, taxes, depreciation, and amortization. While the accounting for the company renting the asset has changed significantly, the perspective of the company supplying the asset, the lessor, remains different. MFRS 16 now creates an accounting asymmetry. Lessors do not use a single ROU model. They continue to use a dual classification system. Lessors must determine if a lease transfers substantially all the risks and rewards of ownership to the customer. If those risks and rewards are transferred, it is a finance lease. The lessor removes the physical asset from their books and records a net investment in the lease as a receivable. If the risks are retained by the lessor, it is an operating lease. The lessor keeps the asset on their balance sheet, depreciates it, and records rental income over time. This dual model persists for lessors because it reflects the economic difference between acting as a financier and acting as a traditional landlord. A sale and leaseback occurs when a company sells an asset it owns and immediately leases it back from the buyer. For this to be valid, the initial transfer must meet the revenue recognition requirements of MFRS 15. If it does not qualify as a sale, the entire transaction is accounted for as a loan. If a valid sale occurs, the seller-lessee must measure the new ROU asset at the proportion of the previous carrying amount that relates to the rights they have retained. Consequently, the seller-lessee can only recognize a gain or loss on the portion of the rights that were actually transferred to the buyer. These rules prevent entities from using sale and leaseback transactions to artificially inflate immediate profits while maintaining full control over the asset. Consider a scenario where Alpha BHD rents a specific floor in a commercial building for 100,000 ringgit per year. The contract includes a clause stating the landlord can relocate Alpha to a different floor at any time, and would benefit financially from doing so by freeing up space for larger tenants. When we apply the MFRS 16 identification matrix to this specific clause, the focus shifts to the nature of the asset specification. Under these terms, the contract does not contain a lease. The landlord's substantive substitution right means there is no identified asset. This confirms the ultimate requirement of MFRS 16. If the supplier can easily swap the asset to suit their own economic interests, the customer does not have a lease. It remains an operating expense, leaving the balance sheet unaffected.